So very happy of all. So we are going to start the next chapter called as financing decision in that capital structure. Basically, this chapter is called as capital structure theories. Capital structure theories. So we are going to take capital structure decision, my dear noble students. In this chapter, actually, three things we have to discuss. If we discuss three things, this capital structure theories chapter comes to an end. Number one, various theories we are supposed to discuss. Number two, arbitrage process we are supposed to discuss. And EBIT and EPS analysis we have to discuss. These are the three areas which the ICAI will test you. Number one, theories, my dear noble students. This is the background of the theories. We are going to have a big fight, my dear noble students. If two firms are alike in all aspects, except capital structure, will the value of the firm change or not is the question. So what we are going to talk is there are two companies, one is A Limited and other is B Limited. Both A Limited and B Limited are doing same business. Both A Limited and B Limited business is one and the same. Capital employed are one and the same. And the risk of the business are one and the same. Sir, EBIT generated by both the business are also one and the same. That means if two firms are alike in all aspects, except capital structure. Except, will the value of the firm change or not is the question. Sir, because of the capital structure, will the value of the firm change? So some theories are saying that yes, if the capital structure changes, value of the firm changes. Some theories are saying that no. How, sir, if two firms are alike in all aspects except capital structure alone, how the value of the firm change? So theories classified into two categories. There are two types of theories. One is theory of relevance and theory of irrelevance. Theory of relevance is saying that even though if two firms are alike in all aspects except capital structure, the value will change. There are two theories supporting the theory of relevance. That is net income approach. Number one is what? And number two is traditional approach. Number two is theory of irrelevance is net operating income approach and the Modigliani-Miller approach. Modigliani. So what is the reason why these two theories are saying if two firms are alike in all aspects? For example, A Limited is there and B Limited is there. If they are doing the same business, for example, cloth business, if they are having same capital employed, 50 lakhs and 50 lakhs, sir, since both are in the same business, the beta, the diversifiable risk, non-diversifiable risk of the company will be one and the same, and the EBIT generated by both the company are also same, then how the value of the firm changes is what the primary understanding. Because everything should be same, the value of the firm should also be same. It's like two cows are there. Cow number one will give you 5 liters of milk, and cow number two also will give you 5 liters of milk. Are you with me? Yes, sir. If you are going and purchasing the cows in market, if someone is saying that for cow number one it is 10,000 and cow number two is 15,000, will you accept it? No. So there should be some basic reason. So the basic reason is a relationship of the cost of capital. Basic reason for the difference is a relationship of the which is nothing but one. KD and the K. Relationship of KD and the my dear noble students, KD is the cheaper source of finance. KD is the whereas K is the costlier source of finance. K is the so KD is a approximation of the profit or a charge against the profit. Charge against the profit. That mean debt will be debited to the P&L account. Are you with me? Yes, sir. And KE is a sir after paying the PAT from the profit after tax. I am paying the equity dividend. Are you with me? Which cannot be debited to the what account? P&L account. Which cannot be debited to the. That means sir always KE is a costlier source of finance than the KD. Always KE is a costlier source of finance than the. So the primary sir base of this chapter is even though two firms are alike in all aspects except capital structure. That means sir one firm is having debt inside the capital structure. Another firm is a all equity firm. They does not have debt in the capital structure. That means if the KD is equal to 10% and KE is equal to 15%, my dear lovable students, if a firm is a all equity firm, their 100% of the capital comprises of KE is equal to KO. That means which is equal to how much percentage? 15%. But sir, in the same place, there is another firm in their capital structure. They are having both sir debt and what equity. If you inject debt into the what structure? Capital structure, my dear lovable students, automatically because of the cheaper source of finance which is present inside the what structure? Capital structure. We know that KO means weighted KO. That is weighted average cost of. So KO is equal to weight of the equity into KE. Are you with me? Plus the weight of sir debt into KD. That is KD into weight of the debt. This is what our KO is all about, right? So this is the basic understanding or knowledge which is saying that if even though if two firms are alike in all aspects except capital structure, yes, the value of the firm will change. Yes, the value of the firm will. My dear lovable students, there are two people who are saying that yes, the value of the firm will change. That is called as net income approach and the traditional approach. So we are going to start. These are the learning objective of this chapter. Number one, capital structure theories. Number one. Number two, net income approach, shortly called as NI approach. Shortly called as then traditional approach. What approach? Both this theory are theory of relevance. Both this theory are theory of. Then we are having NOI approach. Then we are having Modigliani-Miller approach. Modigliani. Then we are having trade-off theory and we are having pecking order theory. What order theory? This is just a theory only. There is no numerical part from the trade-off theory and the pecking order theory. So just we have to understand for 1 or 2 mark in examination what is trade-off theory and what is pecking order theory. Are you with me? Then we have to take a decision, capital structure decision through EBIT, EPS analysis. EBIT, EPS. In capital budgeting, we will use sir NPV as a tool to take a decision, right, sir? Sir, the same way, sir, which capital structure I want is based upon my EBIT, EPS analysis. What analysis? So first of all, we are going to take a decision. First, the decision is the sir, financing decision. What decision? Financing decision will lead to capital structure decision. Financing decision will lead to. So capital structure decision refer to designing the form of financing. That is which source to be tapped. So if you are going to raise a fund of 50 lakh, whether you have to raise by equity, whether you have to raise by debt, or whether you have to raise by mix of both, such a decision is called as capital structure decision. That is a chapter, capital structure decision. But it is not capital structure theories. That is different. Capital structure decision means in my capital structure, how much percentage should be the equity, how much percentage should be the debt, how much percentage should be the preference. Are you with me? Their actual capital requirement, amount to be funded, and their relative proportion makes in the total capitalization. For example, if I am going to raise 100 lakh rupees fund, my dear lovable students. So my question is, out of this 100 lakhs, how much should be debt, how much should be equity, how much should be preference, how much should be retained earnings? This decision is called as capital structure decision. This I will decide based upon the tool called as EBIT, EPS analysis. Are you with me? So first First of all, I have to take capital budgeting decision. Capital budgeting decision means if I am having money, I will purchase plant and machinery. Right, sir? There I will take replacement decision. There I will take modernization decision. There I will take expansion decision. There I will take diversification decision. These are the major capital budgeting decision we will take. In order to take a dash budgeting decision, capital budgeting decision, we have to raise the fund. There are various sources are there for raising the fund. Either you can raise the fund internally, that means through internal fund, or you can raise the fund through debt, or you can raise the fund through external equity. Internal fund are called as reserves and surplus. Correct? Debt means debt, that means debentures. Yes, sir. And external equity means you are raising equity shareholders, sir, or preference shareholders. This is what need to raise the fund. So I am going to do a capital budgeting decision. In order to take a capital budgeting decision, I have to raise the fund. Right, sir? These are the various sources of fund. Then only I can take a capital structure decision. Sir, if there is no project, I don't want fund at all. It is like business, how it will work. Like, okay, I am having 100 crores in my hand. I have to do something. Let me do this business. No, how will the business work out? First of all, there should be a good project. If there is good project, in order to do that project, I need fund. So the business should start with the capital budgeting decisions. That's what they say. So through capital budgeting decision means a replacement decision, or modernization decision, or expansion decision, or diversification decision. So I have to take one of these decisions. For example, sir, I am ANM classes. I have to put another branch. That means I am going for expansion decision. Alright, sir. Sir, now I am doing only CA. I am going to start ACCA. It's diversification. Or I am going to modernize the classrooms. That is called as modernization. Or I am going to replace the existing camera with a new camera. That is called as replacement decision. To do any of this, I need what? Fund. I have to raise the fund. There are various options available to me as an owner. Either I can raise the fund through internally, or I can borrow the money, or I can go for equity. These are the main three options available with me. Sir, if out of these three options, how much should be the internal fund? How much should be the debt? How much should be the external equity? That percentage, that mix is called as capital structure decision. Capital? Okay, right. That means, sir, existing what structure? Capital structure. Then I will check that am I an existing company or a new company? If I am an existing company, what is the existing capital structure? Currently, how much equity I am having? Currently, how much debt I am having? Currently, how much internal funds are available? Right, sir? And the payout policy, this is called as dividend decision. Are you with me? Yes, sir. Payout policy. Because if I am having 100% payout policy, there is no internal fund at all. Because there will be zero retained earnings, right? That means to do the project, I won't have the dash at all, internal funds at all. So my payout policy is also one of the factors which will determine the what structure decision, capital structure decision. Alright, sir? So what is my existing capital structure will decide, and my payout policy will decide. Based on that, I will make desired debt equity mix. Desired debt equity mix. Sir, when I make the desired debt equity mix, I have to see what will be the effect on the return, and what will be the effect on the risk, and what will be the effect of what of capital, cost of capital. Because of injecting more equity into the what structure, capital structure, if KO increases or KO decreases or KO remaining constant, anything happen, my dear lovable students, sir, it will affect my value of fund. It will affect me. So I should take a decision where after I taking that optimum capital structure decision, my KO should be minimum. My KO should be, if the KO reduces, value of the firm increases. If KO reduces, so my dear lovable students, all these decisions I am going to take. So in my capital structure, how much should be the percentage of debt? How much should be the percentage of equity? How much should be the percentage of reserves and surplus? This is called as what structure decision. We are going to take the capital structure decisions that we will be making using a tool called as EBIT EPS analysis. What analysis? Before we talk about EBIT EPS analysis, first we will be talking about capital structure theories. Capital, as I already introduced, that if two firms are alike in all aspects, except capital structure, will the value of the firm change or not is the question. Right, sir? The following approaches explain the relationship between what of capital, cost of capital, and what structure and the value of the firm. That comparison, that study is called as capital structure theories. That means what will happen to my KO, sir, if the capital structure changes. Now you should have understand that what is capital structure. That is the mix, the percentage of debt and equity in my capital structure is called as capital structure and the V of what of the firm. There are two theories are there, sir, the theory of relevance and theory of irrelevance. Tell me, theory of relevance and theory of relevance is saying that if two firms are alike in all aspects, except capital structure, yes, the value of the firm will change. That is called as net income approach. What approach? And traditional approach. And what approach? No, sir. If two firms are alike in all aspects, except what structure? Capital structure, how the value of the firm will change. That is called as theory of irrelevance, sir. Net operating income approach and Modigliani-Miller approach. Modigliani. So set your mind, there are two theories are there. Theory of relevance, theory of what is the argument of theory of relevance that you understand? If two firms are alike in all aspects, except capital structure, yes, the value of the firm change. First of all, you should understand the basis of the argument because one of the firms are only having equity. Other firm is having equity and debt. That means KD and KE is there. KD is a cheaper source of finance, whereas KE is a costlier source of finance. Correct? So if any company injecting debt into the what structure? Capital structure. Since KD is a what source of finance? Cheaper source of finance. Surely KO reduces. If KO reduces, value of the firm increases. This is what NI approach. What approach? So according to this approach means what approach? NI approach. Capital structure decision is relevant to the what of the firm. So what NI approach is saying that if two firms are alike in all aspects except what structure? If one firm is a all equity firm and other firm is a levered firm, that means in the capital structure of the levered firm, what and what is that? Debt and equity. That this represent the debt represent the KD and the equity represent the KE. This will be their KO. Whereas for all equity firm in their capital structure, only who will be there? Equity will be there. So KE will be equal to in the comfortable level. That means, my dear lovable students, we know that KE will be cheaper source of finance and KE will be costlier source of finance and KD will be cheaper source of finance. So since the first guy is having only equity in their what structure? Capital structure, automatically their KE will be higher. Automatically their KO will be higher. Comfortable. Whereas the second person, since we are going to take the back, that is weighted average cost of capital. Hello, sir. Since inside their capital structure, what and what is there? Debt and equity is there. In that, debt is a cheaper source of finance. Because of that, KD pulls down KO. KD pulls down KO. Because of KD pulls down KO, once the KO reduces, value of the firm increases. Value of the firm. So that's what they are saying, sir. According to this approach means NI approach. Capital structure decision is relevant to the what of the firm, value of the firm. An increase in financial leverage. Financial leverage in the sense means use of debt in the capital structure. That is called as financial leverage. If you are using debt in the what structure? Capital structure. You will say that such a situation is called as financial leverage. What leverage? Will lead to decline in the weighted average cost of capital. Yes, if I inject debt into the capital structure, sir, I am injecting KD into the capital structure, right? If the proportion of the debt increases, proportion of the cheaper source of finance increases. Understanding? If proportion of the cheaper source of finance increases, it pulls down the KO. If KO reduces, value of the firm increases. If KO reduces, that means while the value of the firm as well as market price of the ordinary share will increase. So what NI approach is saying that let the two company be there. Let the two company be there. Sir, it is A Limited is doing only business of cloth, and even B Limited is also only doing business of what? Cloth. And 50 lakhs is a capital employed, and 50 lakhs is a what employed? Capital employed. I don't know. Assume the beta of this business is also 1.5 and beta of that business is also 1.5, right, sir? And EBIT generated by both the business are 40 lakhs and sorry, sir, EBIT generated by both the business are 12 lakhs and 12 lakhs. Let it be same. Still, value of the firm will change. What is the basis of such a statement by NI approach? Because NI is saying that what is the nature of A Limited? You are saying that it is a all equity company. It is a if it is a what equity company? All equity company, its KO is equal to KE. Am I right? Yes, sir. KE does not have any tax benefit. Am I right? Yes, sir. It is the costlier source of finance. The expectation of the equity shareholders will always be higher than KD. Correct? So automatically their KO will be higher. Their KO will be. But NI is asking a logical question that what is the nature of this firm? This firm is a levered firm. Levered firm means in their capital structure, who is there? Debt is there. That means KD is there and KE is there. Right, sir? KD is a what source of finance? Cheaper source of finance. So if you inject debt into the what structure? Capital structure, my dear students, automatically KO reduces. So KO reduces, value of the firm increases. Value of the firm. This is what the theory of the NI. Conversely, a decrease in the leverage. Decrease in the leverage means if you are reducing the component of debt in the what structure? Capital structure will cause an increase in the overall cost of capital and consequence decline in the value as well as market price of the equity share. So what this approach is saying that if you are injecting more and more and more debt into the capital structure, sir, automatically the proportion of the debt in the capital structure increases. Then it is a cheaper source of finance. Because of that, KO reduces and its value of the firm increases. So the value of the firm on the basis of the net income approach can be ascertained as follows. Sir, value of the firm is equal to value of equity plus market value of debt. So market value of equity plus market value of the debt. So according to the what approach? NI approach. They are saying that, sir, market value of the firm is equal to market value of equity and market value of debt. Market value of equity and market value of debt. Why are they saying, sir? Sir, if it is NI approach, if it is what approach, man? This is the basic understanding of the NI approach, my dear students. Sir, always this capital structure is a comparison of the cost of capital. Correct? Sir, KE and KD are there. KE and, sir, this KE will always constant. KE will always, and KD will always constant. KD will, that means if you inject more and more and more debt into the what structure also, capital structure also, KD will be constant. KD will be, and KE will be constant. KE will be. Sir, since both are constant, look at here, man. This is the cost of capital percentage, and this is the leverage. Leverage means percentage of debt. Leverage means what? Percentage of debt. Sir, if there is no debt, you are saying that zero debt you are having, then KE is equal to KO. It will be a dash equity form, all equity form. But if you are introducing debt up to this man, if you are introducing up to this level, have you introduced debt? Yes, sir. Then KD will not change. KD will be what? Constant. And KE will be what? Constant. Because of both the people constant, my dear students, KO reduces. KO. Look at the KO. This is what KO. Sir, this was the KO earlier. Because if there is no what at all, debt at all, KE is equal to KO. So this line represents earlier what? KO. KE is equal to KO. Correct? But I inject this much debt into the what structure? Now the capital structure comprises of KD and what? KE. In that KD is a dash source of finance. Cheaper source of finance. Since it is a cheaper source of finance, it pulls down KO, which is nothing but KE. Are you really with me? That's why the KO starts falling. Look at here. The KO starts falling. Now I again injected what into the capital structure? Debt into the capital structure. Then again KO starts falling. Are you really with me? When I inject more and more and more debt into the what structure? Capital structure. Sir, my KO will start falling. If my KO reduces, my value of the firm increases. Are you really with me? How to deal this, sir, in the examination? Sir, this is a 5-step approach. This is a 5-step approach. This is a, so if question is coming from NI approach, deal it with 5-step approach. Always try to calculate EBIT and interest. Always try to calculate EBIT and interest. EBIT means earnings before interest and tax. Right, sir? And interest means whatever interest applicable to the firm. Then calculate the market value of equity. Market value of equity. And calculate the market value of debt. Market value of, if you calculate market value of equity, and if you calculate market value of debt, and if you add value of equity plus value of debt, you will get a total value of the firm. You will get a total value of the firm. This line only they are saying that, sir, value of the firm is equal to market value of equity plus market value of debt. Comfortable? Market value of equity plus market value of, yes, sir. Why, sir? Under NI approach, I am calculating market value of equity and market value of, because equity means KE and debt means KD. Correct? As per NI approach, both the KE and the KD are constant. So constant means it will not change. So I am finding out the item which will not change. Then I can find out the item which will change. That is KO. KO will change. Are you with me? But this is a logic way. As per NI approach, my dear students, market value of the firm is equal to market value of equity plus market value of debt. Market value of, sir, once I find out the fixed item, I can find out the variable item. Are you with me? The variable item is the overall cost of capital. That is what? KO. KO is the overall cost of capital. Is it fixed or constant? Is it, sir, constant or variable? Variable. It should be variable. Then only the NI approach will be theory of relevance. Because in order to be theory of relevance, the value of the firm should change. In order to value of the firm should change, my dear lovable students, KO should change. Are you with me? So EBIT divided by value of the firm. Tell me EBIT divided by. So my dear lovable students, if it is NI approach, what NI, sir, net income approach is saying that these are our basic assumption. You will be having KD in your what structure? Capital structure. You will be having KD in your, sir, the combination of these two is only what? KO. This will be treated as constant. This will be treated as constant, and this will be treated as variable. Are you with me? Now, sir, what is the value of the firm? Value of the, sir, value of the firm as per NI approach is saying that value of the firm is nothing but value of equity plus value of the debt. Are you with me? Now everyone is asking about that. What is value of equity? Value of equity is nothing, sir. Value of equity is equal to NIT, EBIT minus interest. EBIT, because if a company earns EBIT, they have to pay interest to the debt holders. Are you with me? Sir, balance only will be available to the equity shareholders. Are you with me? That is the return the equity shareholders will be getting. Sir, divided by KE, divided by. Just let me ask you a question. You are an equity shareholder in a company, and in that company debt is there. Is company liable to pay interest? Yes, sir. Sir, the entire EBIT can be consumed by equity shareholders, or EBIT minus interest can be consumed. EBIT minus interest can be consumed. Are you with me? Since the equity shareholders will get only EBIT minus interest, that is called as earnings available to equity shareholders. Earnings available to the equity shareholders. You tell me, man, once you become an equity shareholder, will you get earnings available to the equity shareholder for 1 year or 10 years or infinite years? Infinite years. That means the cash flow is a perpetual cash flow. Cash flow is a Sir, if cash flow is a perpetual cash flow, then value of an asset today is called as the value of equity. Are you with me? Is equal to cash flow divided by R. What is cash flow? EBIT minus interest. What is R? KE is R. That is the rate. Are you with me? Sir, now you are the owner of the what also? Debt also of the company. Are you with me? That means will you get EBIT, EBIT minus interest, or Veru interest? Veru interest. That means if you are debt holder, sir, you can enjoy only interest. Are you with me? This will be the future cash flow. Are you with me? Since this is a what cash flow? Future cash flow. The expected return will be KD. Expected return will be. That means, my dear lovable students, sir, value of equity plus value of debt is equal to value of firm. So I can say that value of firm is equal to value of equity plus value of debt. Value of equity is equal to, if you are equity shareholder, can you enjoy EBIT? EBIT minus interest. So EBIT minus interest, correct? Divided by NI. KE, are you with me? Plus the value of the debt means I can enjoy what? Interest divided by KD. Let me ask you a question. If you are holding 100% of the debt and 100% of the equity in a company, will you enjoy interest? EBIT minus interest. I will enjoy EBIT. Are you with me? That means if I am 100% shareholder and 100% debt holder, I will be enjoying EBIT. Yes, sir. That means minus interest and plus interest, not mathematically, logically, I am cancelling. Are you with me? That means if I am holding 100% of the company, I can enjoy what I did? EBIT. Now I am the equity shareholder, I am the debt holder. That means KE plus KD is equal to KO. That's why the value of the firm is equal to, sir, EBIT divided by value of the firm will give you the KO. Are you with me? That's the derivation of the formula they are saying. Simply they are saying that, sir, value of the firm is equal to EBIT divided by KO. But as per what approach? NI approach, I have to calculate the KO. KO is equal to EBIT divided by value of the firm. EBIT divided by. In other words, KO means overall cost of the capital. This can be written as return on investment. Return on investment is equal to return divided by investment. Am I right? So what is a return? EBIT is a return. Are you with me? In order to enjoy EBIT, whether you have to invest value of equity, value of data, value of firm. That's why value of the firm. So KO is equal to EBIT divided by value of the firm. Comfortable? That's it with regard to the first theory called as NI approach. NI is saying that try to inject more and more and more debt into the. If you are injecting more and more and more debt into the capital structure because of the presence of the cheaper source of finance, that is KD. KD pulls down KO. Once KO reduces, value of the firm increases. It's a 5-step approach, my dear students. Step number 1, find out EBIT and interest. Step number 2, find out the market value of the equity. So you have to EBIT minus interest. You are supposed to write down EBIT minus interest. So first you have to calculate EBIT and interest. Then market value of the equity, market value of the debt. Then you will get a market value of the firm. Are you with me? Now you are having EBIT in your hand. You are having market value of firm in your hand. The expected rate is called as KO. Comfortable? I'm coming to the next one, sir. Next theory I'm going to explain called as net operating income approach. What approach? Sir, what NI said that, this is how you have to understand. NI, net income approach, said that 3 characters will be there. One is called as KE, other is called as KD, and other is called as what? According to NI approach, if you are having 10% debt or 90% debt, whatever may be the proportion of debt in the what structure, capital structure, your KE will be constant. Am I right? Sir, if you are having 0 debt or you borrow 100% debt, still the KD will be what? Constant. Sir, because of these two people constant, sir, because of injecting cheaper source of finance into the what structure, capital structure, automatically KO reduces. Right, sir? Now, NOI approach is having a criticism over the NI. NOI is asking that if you inject more and more debt into the capital structure, how the fear of the equity shareholders will be one and the same. Because earlier, if this is the capital structure, for example, 10 crore is the capital structure, you can have various options. Option number 1, this is debt and this is equity and this is total. Always the total will be how much crore? 10 crore. You can have 0 debt and you can have 10 crore as equity. My dear lovable students, in option number 2, you can have 1 crore as debt and 9 crore as equity. You can have option number 3, you can have 2 crore as debt and 8 crore as equity. Total comes to 10 crore. Able to appreciate. In option number 4, you can have 3 crore and 7 crore and the total will be 10 crore. What NOI is asking that if you are asking me to inject more and more debt into the what structure, capital structure, your analysis is correct. You are saying that KD will be constant. Are you with me? But NOI is asking a basic critical doubt to the NI that how KE will be constant, man. Because if you inject more and more debt into the what structure, capital structure, automatically the buy-in of the equity shareholders increases. So your basic assumption of KE constant is useless. Are you with me? It is unacceptable. I can't accept that at any point of time because this is the KO, my dear lovable students. Sir, KO, sir, this is KO. If you inject debt into the what structure, capital structure, KD pulls down. KD pulls down KO. But sir, automatically the fear of the equity shareholders increases. They pull up the KO and KO remain constant. And KO remain. If KO remain constant, value of the firm will not change. Value of the firm. But what NOI is saying that, Tambi, we are having 3 sources of items. Number 1, KD and KE and KO. I am saying that KD will be constant. I am saying that KD will be constant. Are you with me? And number 2, sir, KE will be not constant, will be variable. And KO will be constant. KO will be, sir, how the NOI will work now? This is the KO. This is the, when you inject debt into the what structure? Capital structure. KD is the cheaper source of finance. Because of that, KD pulls down KO. Now KO reduces, value of the firm increases, but NOI is saying that if you inject debt into the capital structure, the buy-in of the equity shareholders increases and KE increases and it pulls up KO and KO remain constant. That means KO will not change. If KO will not change, KO does not change. My dear lovable students, my value of the firm will not change. That's why NOI approach is a theory of irrelevance. Is a theory of any change in the leverage will not lead to any change in the total value of the firm. NOI is asking that if first guy is doing Selbu business and second guy is doing Pune business, then they can have different value of the firm. Are you with me? If both the people are doing same business with the same capital employed, with the same return, with the same risk, how the value of the firm will change? Simply because of the reason that one is a all equity company, other is a debt and equity company. Question arises. and the market price of the share and the overall cost of capital is independent of the degree of leverage. Whether you are injecting 10% into the capital structure or 20% into the capital structure or 30% into the capital structure does not matter at all. Whether you are having debt, not having debt, because of that, the value of the firm will not change. This is the ideology of the NOI approach. Are you with me? As a result, the division between the debt and equity is what? Irrelevant for me. For the net operating income approach. As per this approach, increase in the use of debt, which is apparently cheaper. He's also accepting that KD is cheaper. There is no doubt about it. Is exactly offset. Is what? Exactly offset by an increase in the KE. That's what he's simply saying. Superintendents, are you with me? Yes, sir. This is what? Oh, KO. Sir, when you inject debt into the capital structure, KD pulls down. KO. Yes, and KE pulls up. KO remain unchanged. This happens because equity investors seek higher compensation as they are opposed to greater risk due to existence of fixed return securities in our structure. If you inject more debt into the capital structure, automatically the risk of the equity shareholders increases. Risk of the because of fixed interest-bearing securities or the fixed amount increases. Are you agree with me? Then automatically, my dear lovable students, what will happen? You know, the expectation of the equity shareholders increases. When the expectation of the equity shareholders increases, KE increases. Are you agree with me? When KE increases, it pulls up KO, and the KO remain constant. Actually, this is what the position of the KO. It goes down. Are you agree with me? Because of and it comes up because of K, and now KO is constant. Comfortable? What NOI is saying that as per my approach, whose approach? NOI approach. KD will be constant. KD will be, and KO will be constant. KO will be, and you have to calculate the KE. KE will be variable. KE will be. Now, NOI is an ulta. NOI is an ulta of the NI approach. He said that step number 1, first calculate the EBIT and interest. First calculate the EBIT. For every company, you have to see how much is the EBIT and how much is the interest. Hello, sir. And according to the NOI, will the KO changes? Will not changes. Will not changes. If KO does not change, value of the firm changes. Will not changes. So calculate the value of the firm. Calculate the. That should be the step number 2. Sir, it should not be like market value of equity plus market value of debt. Anyway, the what of the firm will not change. Value of the firm will not change. So first to find out the value of the firm. Inside this value of the firm, 2 people are there. One is value of debt and value of equity. Is KD constant or variable? Constant. That means anyway value of the debt will not change. Right, sir? From the value of the firm, reduce the what of the debt. Value of the debt. Then automatically value of the firm minus value of the debt. You will get the value of equity. Value of. Yes, my dear lovable students, can you find out EBIT minus interest in step number 1? Yes, sir. This is the earnings available to the equity shareholders. Sir, can you get the value of the equity? Yes, sir. Then automatically their expectation will be KE. So step number 5, KE is equal to EBIT minus interest divided by value of the equity. Comfortable? So think like this. NI is saying that KD is constant, KE is constant, KO is variable. So first to find out EBIT and interest. Comfortable? Then find out market value of the equity. Then find out market value of the debt. You add market value of equity plus market value of debt. You will get the market value of the firm. You are adding EBIT in your hand. You are adding market value of the firm in your hand. Find out the KO. Are you with me? Because sir, NI approach is a theory of relevance. So there, in order to be theory of relevance, we have to calculate the KO. Comfortable? Whereas NOI approach is a theory of irrelevance. There, KO should not be the balancing figure. Either KD or KE should be the balancing figure. Comfortable? What he is saying that KD is constant and KO is mandatorily to be constant. Agree with me? Then the only balancing figure is what? KE. So under NOI approach, we have to calculate the KE. Comfortable? So how he is designing the problem? First calculate the EBIT and interest. Then straight away calculate the known figures such as market value of the firm. Inside the market value of the firm, market value of debt is there. Market value of equity is there. Agree with me? My dear lovable students, remove the market value of the debt. You will get the market value of equity. You are having EBIT minus interest. You will be getting earnings available to the equity shareholders. Divided by market value of the equity, you will get the. That means NOI is saying that is how many step approach? 5-step approach. Are you with me? So the value of the firm is equal to EBIT divided by KO. EBIT divided by KO. Sir, V means what of the firm? Value of the firm. Sir, NOI means net operating income. KO means what of capital? Cost of capital. As per NOI, I am not liable to calculate the KO or value of the firm. I have to calculate the KE. KE is equal to EBIT minus interest divided by value of the equity. Value of the. That means as per NI approach, I have to calculate the KO. Correct? KO is equal to EBIT divided by value of the firm. EBIT will be given in the value of the firm will be value of equity plus value of debt. Comfortable? Whereas here, KE is equal to EBIT minus interest divided by value of EBIT and interest will be given in the question. Value of equity means value of the firm minus value of the debt. Can you proceed? Now I'm going or enter into the next theory called as traditional approach. What approach? Traditional approach is asking one basic question with the same example. Look at here, man. NI, you said that KD will be constant, KE will be constant, right? But NOI said that KE will not be constant, KE will be variable, KE will be variable. Am I right? NOI said that KD will be constant. Are you with me? And here he said that KO will be constant. I'm writing as per what approach? NOI approach, right? Traditional approach is asking a basic question or doubt to both NI and NOI saying that because you are asking me to inject more and more and more debt into that. The person who are giving debt to you, sir, they won't have any risk. They won't have any risk. Even the KD should also increase. Sir, if you inject more and more and more debt into the what structure? Capital structure, the expectation, the risk of the debt holders will also increases. Then automatically KD increases and the KE will also increases. My dear lovable students, if KE also increases, KD also increases, automatically KO increases. If the KO changes, not increases KO. If the KO changes, then automatically value of the firm will change. Automatically. That's why, sir, traditional approach is called as theory of relevance. Because in order to be theory of relevance, my dear lovable students, who should change? KO should change. If KO changes, value of the firm changes. If value of the firm changes, it will be theory of relevance. Are you with me? So what traditional approach is saying that this approach favors that as a result of what leverage, up to some point, cost of capital comes down. That means initially this traditional approach is supporting NI approach. Initially, traditional approach is saying that if you are injecting 10% debt into the what structure, what NOI said that KD pulls down, KO, and KE pulls up, and KO remain constant. Traditional approach is saying that it is not like that. Once you inject 5 or 10% debt into the what structure, actually equity shareholders will enjoy that position. Are you with me? Because financial leverage will work favorably. Are you with me? Actually trading on equity will happen. Actually the equity shareholders will be having more EPS if you are having minimum debt. So initially, what will work? NI approach will work initially, and value of the firm increases. But if they were purposefully beyond that point, reverse trend emerges. Beyond that point, reverse trend emerges means once you keep on injecting debt into the what structure, capital structure, who will start react? Equity shareholders will start react. Once they start react, and who will also start react? KD will also start react. That means who will increase? KD increases, and also KE also increases. But NOI, you said that it will be exactly offset. It will be, but the change will not be exactly offset. So if KD increases by 5%, the KE will increase by 15%. It will be a steep increase. It will be a steep increase. That means KE will not be exactly offset by the other students. The principal implication of this approach is that cost of capital is dependent on the what structure. And there is an optimal what structure? Capital structure, which minimizes the cost of capital. This is a super point in the traditional approach by the other students. Sir, what NI is saying that KD is constant, KE is constant, and KO is variable. Correct, sir? Yes, sir. KO is variable. Whereas NOI is saying that KD constant, KO constant, and KE is variable. Able to appreciate? What traditional approach is saying that when you inject debt into the what structure? Capital structure, initially KO reduces. Initially, but if you inject more and more and more debt into the what structure, KD increases, even KE also increases. But the proportion of increase in KE will be much higher than that of KD. I don't know what you mean. Because of that, KO increases. Because of that, if KO increases, value of the firm decreases. Am I right? So up to a level, KE will not react. Up to a level, KE will not react. Up to a level, KD will not change. I don't know what you mean. ஒரு லெவல் தாண்டினதுக்கு அப்புறம் ரெண்டு பேர் என்ன ஆரம்பிப்பாங்க? இன்க்ரீஸ் ஆகும். அந்த இன்க்ரீஸ்ல யாரோட இன்க்ரீஸ் ரொம்ப அதிகமா இருக்கும்? KEயோட இன்க்ரீஸ். அப்ப அந்த இன்க்ரீஸ் ஆவற அந்த பாயிண்ட் இருக்கு பாத்தியா? That is called as optimum capital structure. What capital structure? Under NI approach, you won't have optimum capital structure. Under NOI approach, you won't have optimum capital structure. Logic. Because, sir, when you inject more and more debt into the what structure, capital structure, automatically KD, sir, KO reduces. 10% I inject debt, then KO reduces by 10%. Correct? I inject more debt, 20%, then KO reduces by 20%. Are you understanding? If I inject 50% debt, then KO reduces by 50%. Are you agree with me? That means what is the optimum capital structure as per NI? There is no such concept. If possible, try to inject 100% debt. Practically, is it possible? No, sir. But NOI is saying that you inject sir, KO is not going to change. If KO is not going to change, there is no question of optimum what structure at all. Capital structure at all. Are you able to appreciate? But traditional approach is saying that initially when you inject debt into the what structure, capital structure, KO reduces. So when KO reduces, value of the firm increases. Are you agree with me? Are you able to appreciate? That means, my dear lovable students, after a particular point of time only, KO start increasing. Correct? So in the point KO least start go, that point is the optimum what structure. Only under traditional approach, you will be having optimum capital structure. Under NI and under NOI, you won't have optimum capital structure. Can you proceed, sir? So what traditional approach is saying that KD will change, KE will change. If both the people changes, automatically KO will change. So KD will change. So according to this approach, KD will change, KE will change, automatically KO will change. KO will also change. This is what the theory called as traditional approach. Are you with me? So NI is a theory of relevance. NOI is a theory of irrelevance. And the traditional is a theory of relevance. Coming to the last one, the hero called as Modigliani-Miller approach. Modigliani, so the NOI approach, that is net operating income, is definitional or conceptual. It is correct only if you inject debt into the what structure? Capital structure, KO reduces because of KD. And KE pulls up KO. Are you with me? And it will exactly offset. This is what the theory of the NOI. But it lacks behavioral significance. How it will exactly offset? Sir, NOI was speechless. He was not able to explain why it is exactly offset. So it does not provide operational justification. How it will operate? NOI was not able to say for irrelevance of what structure? Capital structure. That's why who came as hero? Modigliani. Our Modigliani-Miller approach provides behavioral justification for constant overall cost of capital and therefore total value of the firm. Then, sir, there is a defect in the NOI approach, my dear students. NOI approach said that, sir, net operating income, there is a defect. Conceptually, that is right, but the operational justification, it failed. I will give you the operational justification. I will explain you how it will be exactly offset. That means Modigliani-Miller approach is an extension of the NOI approach. Are you with me? So this approach indicates that capital structure is irrelevant. If two firms are alike in all aspects except capital structure, sir, the value of the firm will not change because of the arbitrage process. Because of that, which will correct any imbalance. If there is any imbalance between the levered firm and the unlevered firm, then also it will correct, my dear lovable students, that expectation will change and a stage will be reached where arbitrage is not possible. So there was defect with the NOI approach. Conceptually, NOI approach was correct, whereas, sir, operational justification it has failed. Who gave the operational justification? Modigliani-Miller approach. So Modigliani-Miller said that. Modigliani-Miller said that, sir, if two firms are alike in all aspects except capital structure, the value of the firm will not. He has explained one without tax and he has explained one with the tax. So we are moving with this background. We are moving into the three questions what we are supposed to be solved. Sir, illustration number A, illustration number N, and illustration number M. Shall we apply our discussion into the question, sir? This is a RTP May 2022 question. Following data relates into two companies belonging to the same risk class. Yes, when two companies are alike in all aspects except what structure? Capital structure. Will the value of the firm change or not is the question. Correct, sir? Sir, they are of same what class? Risk class. Same risk class. Hello, sir. Sir, when two firms are alike in what aspect only? All aspects only. I will do this chapter at all. Correct? Sir, this is B limited and this is C limited. B limited is having debtor. That means B limited is the levered firm. Whereas C limited does not have debtor. They are unlevered firm. What firm, man? Equity capitalization rate. My dear lovable students, 18% is the KE of the C limited. KE is equal to KO. Correct? And the expected net operating income, EBIT, is how much lakh? 9 lakh. Why both the company are having same EBIT? Because if two companies are alike in all aspects except will the value of the firm change or not is our discussion. Right, sir? You have to determine the total market value. Total market value means value of the and equity capitalization rate. Equity capitalization rate means and weighted average cost of capital. That means KO for each company. Sir, assuming no taxes as per MM approach. No taxes as per because there was defect in the NOI approach. That's why who came? MM approach came. Are you with me? MM said that I will prove to you with the tax and without tax. And the second part of the question, determine the same total market value, determine the equity capitalization rate and weighted average cost of capital for each company assuming 40% tax as per the MM approach. Right, sir? So same question, the MM is going to prove that when two companies are alike in all aspects except capital structure, just because of the reason that one person are having debt and another person are having does not have debt, that because of that the value of the firm will not change. Are you with me? If you critically analyze B Limited and C Limited, two company, my dear lovable students, think about it. Sir, this is with regard to company number 1 and this is with regard to company number 2. Right, sir? What is the EBIT of the first company? 9 lakhs. Okay, what is the EBIT of the second company? Same 9 lakhs because sir, risk and return should be 1 and less what one interest. Sir, what is the interest paid by the first company? What is the interest paid by? Which is 27 lakhs into 12%. Am I right? 3 lakh 24,000. Yes, sir. So 3 lakh 24,000 is the amount of interest, right, sir? But the second company does not have what at all? Debt at all. Hence, there is no interest at all. Are you agree with me? Yes, sir. So, my dear lovable students, 9 lakh minus 3 lakh 24,000 comes to 5 lakh 76,000 is the profit before tax. Can I proceed? Whereas in the second company, 9 lakh rupees is the profit before tax. Why are you staring, sir? There is no tax. Then why are you getting profit before tax, sir? My dear lovable students, less tax, dash, dash. Okay, wow. So, my dear lovable students, what is the PAT? Profit after tax. The profit after tax in company number 1 is 5 lakh 76,000, right? And profit after tax for the second company is how much lakh? 9 lakh. Now, MM is asking a very logical question. If you are holding 100% of the company as a whole, will you enjoy interest, EBIT minus interest, EBIT? EBIT. That means if you are holding 100% of the company, you will get both interest and PAT. Am I right? What is the interest you will get? 3 lakh 24,000. What is the PAT you will get? 5 lakh 76,000. So 3 lakh 24,000 plus 5 lakh 76,000 comes to. That means if you are holding 100% of the first company, you will get 9 lakh. Right, sir? But if you are holding 100% of the second company, you won't have interest. The interest will be 0, but you will be having PAT of 9 lakh. So then also you'll be having 9 lakh. That means, my dear lovable students, if there is no tax, if there is, according to MM approach, according to what? If there is no tax, value of the levered firm is equal to value of the unlevered firm. Value of the levered firm is equal to value of the. This is what the logic. This is what the logic. Are you with me? Value of the levered firm will be equal to value of the unlevered firm. So always MM is asking that whether you are having tax, not having tax, start your calculation with the unlevered firm. Start your calculation with that. So I'm going to calculate one assuming there is no tax as per what approach MM. So calculation of value of firms, that is B Limited and C Limited according to MM hypothesis. Hello, sir. So the market value of the C Limited, who's that second company? C Limited. What is their specialty? Unlevered firm. MM is asking that always first value the unlevered firm because they don't have debt in their what structure? Capital structure. For them, KE is equal to KO. So KE already given as 18%. That means KO of that company will be also 18%. So I am going to value the market value of the firm unlevered firm. Right, sir? Sir, value of an unlevered firm is equal to EBIT divided by KE or KO, whatever it may be. Hello, sir. Is the EBIT given in the question? If you are 100% owner of that company, you can enjoy EBIT of 9 lakh and your expectation is how much percent? 18%. So 9 lakhs divided by 18% comes to 50 lakhs. Sir, tax there, tax not there. The proposition of the Modigliani-Miller is if there is no tax, value of the levered firm is equal to value of the. If value of the levered firm is equal to value of the unlevered firm, technically means KO of the unlevered firm is equal to KO of the levered firm. Comfortable? So value KE of an unlevered firm given is equal to KO of unlevered firm is equal to 18%. Are you agree with me? Now, sir, I have completed the value of the dash firm, unlevered firm. If there is no tax, value of the unlevered firm is equal to value of the. Now I am going to calculate the market value of the B Limited. That is the first firm. That is what firm? Levered firm. Sir, actually, if there is tax, sir, value of the what firm is equal to? Levered firm is equal to value of the unlevered firm plus DT plus what? DT plus what? So what is the value of the unlevered firm? 50 lakhs. Just now we calculated. Are you agree with me? Plus you are having debt, but you are does not have the T. T stands for what rate? Tax rate. In the bar. That means 27 lakhs into 0. So 50 lakhs will be the what of the firm. That means, sir, what MM's hypothesis is saying that Modigliani-Miller can be classified in how many categories? 2 categories. Without tax and with the tax. Are you agree with me? If it is without tax means value of the unlevered firm is equal to value of the levered firm. Because whatever income you are getting from the levered firm, the same income you will be getting from the unlevered firm. Are you agree with me? Whereas, my dear lovable students, if there is tax, the value of the levered firm is equal to value of the unlevered firm plus DT plus what? DT. D means debt. D means tax rate. Can you proceed, sir? So here debt is there, but tax is not there. Are you agree with me? That means 27 lakhs into 0 comes to 0. So 50 lakhs plus 0 comes to 50 lakhs will be the what of the firm. So are you all settled? The settled in the sense means if there is no tax, value of the levered firm is equal to value of the. Now I am calculating the equity rate. That is equity rate. Are you agree with me? And the back. You tell me what is the B Limited? B means what firm? Levered firm. Sir, why are you not calculating for C Limited? They are already given in the question, which is KE is equal to KO. Sir, whose KE is not given? B Limited's KE is not given. Are you agree with me? Yes, sir. So I have to calculate the KE of the whose Limited? Levered firm. Can we calculate KE? What is the EBIT of the company? 9 lakh. On that, the first company is liable to pay interest of 3 lakh 24,000. Comfortable? From the 9 lakh, if you reduce 3 lakh 24, earnings available to the equity shareholders are 5 lakh 76,000. Comfortable? Yes, sir. As per NOI, first you have to calculate the value of the firm. Am I right? Sir, I already said that MM approach is an extension of NOI approach. NOI fails to give operational clarification. Correct? Now MM is coming and saying that I will explain to you how exactly it will offset. So even the MM is also traveling the same route of the NOI approach only. NOI 5 step calculate the EBIT and interest. Then you have to calculate the value of the firm. Sir, in order to calculate the value of the firm is equal to EBIT divided by KO. But the KO of the levered firm is not given in there. Immediately MM is asking that there is tax or there is no tax. There is no tax. If there is no tax, value of the levered firm is equal to value of the. That means KO of a unlevered firm is equal to KO of a levered firm. Accepting. Are you agree with me? That means, my dear lovable students, I have to adopt the KE as the KO of a unlevered firm. I have to adopt the KO of a unlevered firm as the KO of the levered firm. That means, my dear lovable students, 18% is the KO of the levered firm or unlevered firm because there is no tax. If there is no tax, my dear lovable students, value of the levered firm is equal to value of the So calculate, sir, 5,76,000 divided by 18% comes to, so 5 lakh, 9 lakh, sorry, 9 lakhs divided by 18% comes to 50 lakhs is the value of the levered firm, which is equal to value of the unlevered firm. Why? Because there is no tax. If there is no tax, value of the levered firm is equal to value of the KO of the unlevered firm is equal to KO of the, sir, inside this how much lakh? 50 lakhs. For an unlevered firm, only equity will be there. Am I right? But for a levered firm, both debt and equity will be there. In that KD will be constant as per NOI. The same assumption is there for Modigliani-Miller approach also. That means out of this 50 lakh, how much is the debt included? 27 lakhs. So 50 lakhs minus 27 lakhs comes to 23 lakhs will be the market value of the equity. Market value of, that means, my dear lovable students, sir, in the levered firm, is debt is there or debt is not there? Debt is there. If what is there, debt is there, then automatically the fear of equity shareholders increases. Then it will not be 18%, it will be more than 18%. Correct? So I'm going to calculate the KE. Sir, KE means expectation of the shareholder, equity shareholder, which is nothing but earnings available to the equity shareholders divided by value of equity. What is the earnings available? 5,76,000 divided by what is the value of equity? 23 lakhs. So calculate, 5,76,000 divided by 23 lakhs into 100 comes to 25.04% is the KE. Let me ask you a question. What is the KE of an unlevered firm? 18%. What is the KO of an unlevered firm? 18%. Because there is no debt in the what structure. That means the equity shareholders of an unlevered firm does not have BIAM. But the equity shareholders of the levered firm are having BIAM. Since they are having BIAM, automatically the return expected by the equity shareholders will also be more. Will also be. That's why it is not 18%. That's why it is 25.04%. But my dear lovable students, the KO of both unlevered firm and KO of both levered firm will be one and the same. How to calculate the KO, my dear lovable students? You can calculate the KO by, sir, what by what? EBIT divided by value of the firm. What is EBIT? 9 lakhs. What is the value of the firm? 50 lakhs. So 9 lakhs divided by 50 lakhs into 100 comes to 18% is the KO. 18% is the, so the same KO we can find out by using that table. In the levered firm, equity and debt is there. What is the market value of equity? 23 lakhs. Just now you find out, right? What is the market value of debt? 27 lakhs. What is the total value of the firm? 50 lakhs. That means here I am not putting the book value weight. I am putting market value weight. Are you with me? I can calculate the value using book value weight and what is my weight? What is my weight? That is 23 lakhs divided by 50 lakhs into 100 comes to 46%. 27 lakhs divided by 50 lakhs into 100 comes to 54%. Can you calculate the individual cost of capital? This is KE and this is KD. Correct? My dear lovable students, KD already given in the question as how much percent? 12%. You tell me KO, sir. KO of a levered firm will be equal to KO of an unlevered firm if there is no tax. Conceptual clear? So it should be how much percent? 18%. Calculate 12% into 54% comes to 6.48%. Am I right? So calculate 18% minus 6.48% comes to 11.52% is the weighted KE. Is the what KE? So this should be 46%. Am I right? So calculate 11.52 divided by 46% comes to 25.04% should be the full KE. So here 25.04%. Are you able to appreciate? That means one line summary of the entire discussion is approach can be classified into two categories. Without taxes and with taxes. Are you with me? If it is without taxes, man, value of the unlevered firm is equal to value of the, hence KO of the unlevered firm will be equal to KO of the. Fine, fantastic. To go. I'm going into the next one, man. Assuming 40% tax as per approach. Are you with me? Can you proceed as per 40%? So with the tax, without tax, with the tax. If there is tax, value of the levered firm will be equal to value of unlevered firm, or value of the levered firm will be more than the value of unlevered firm. More than the value of unlevered firm. I will prove even the same question. I can prove even. There are two companies out there, right, sir? Company number 1 and company number 2. Please help me. What is the EBIT? 9 lakhs. What is the EBIT of the second company? 9 lakhs. Sir, is the first company liable to pay interest? Yes, sir. What is the interest? 3 lakh 24,000. Second company put a dash. So earnings before tax of the first company 5 lakh 76,000. Are you with me? 5 lakh 76,000. And here it will be 9 lakh. Sir, less tax at the rate of 40%, which is given in the question. So calculate 5 lakh 76,000 into 40% comes to 2 lakh 30,400. Is the tax to be paid by the levered firm? Are you with me? Whereas 9 lakhs into 40% comes to 3 lakh 60,000 is the tax to be paid by the unlevered firm. That means the PAT, profit after tax, 5 lakh 76,000 into 60% comes to 3 lakh 45,600 will be the PAT of the levered firm. Am I right with my calculation? 9 lakh into 60% comes to 5 lakh 40,000 will be the PAT for the what firm? Unlevered firm. Now, Modigliani-Miller is asking a basic question. My dear lovable students, if you, sir, have tax, if you are holding 100% of the debt and equity, will you get interest from the first company? You would have got interest of 3 lakh 24,000. And from the second company, you would have got 0. Am I right? Sir, equity, sir, you would have got 3 lakh 45,600. And here you would have got 5 lakh and 40,000. So calculate, sir, total return from the company 3 lakh 24,000 plus 3 lakh 45,600 comes to 6 lakh 69,600 from company number 1 and 5 lakh 40,000 rupees from company number 2. Am I right? That means if there is tax, automatically the return generated from a levered firm should be more than the return generated from a unlevered firm. Then if there are two cows, one cow is giving a milk worth rupees 6 lakh 69,600 and another cow worth rupees 5 lakh 40,000, will you buy both the cow at the same rate? That's why is saying that if there is tax, value of levered firm is equal to value of unlevered firm plus DD. Plus what? DD. Plus what? DD. Are you really with me? That means nothing but, my dear students, look at here, man. Value. So calculation of value of firms, there is B limited and C limited according to hypothesis. Market value of C limited always as per first value the dash firm, unlevered firm. First value the unlevered firm. So for unlevered firm, look at here, man. Simple, man. You have to be with me. Sir, in order to value the levered firm, first I have to value the unlevered firm. Correct? Sir, value of unlevered firm is equal to basically EBIT divided by KE. This was the earlier formula if there is no tax. Correct? But if there is tax, sir, the equity shareholders cannot enjoy what? EBIT. Equity shareholders can only enjoy PAT. Are you with me? That means the value of NF firm is equal to unlevered firm is equal to EBIT into 1 minus T. EBIT into 1 minus T divided by KE divided by what? Tell me, what is the EBIT of the second company? 9 lakhs. 9 lakhs is the EBIT into 1 minus T. What is tax rate? 40%. So into 0.14 divided by what is KE? 18%. So calculate 9 lakh into, sir, 0.6 comes to 5 lakh 40,000 is what? Look at here. 5 lakh 40,000 is the PAT. Are you with me? That's what I've reached. If there is no tax, value of unlevered firm is equal to EBIT divided by KE. But if there is tax, value of unlevered firm is equal to EBIT into 1 minus T divided by KE. Put the difference. That means 5,40,000 divided by 80%. So 5,40,000 divided by 80% comes to 30 lakhs is the dash of the firm, value of the firm. If there is tax, let me ask you a question, sir, to ensure that you are with me for the calculation. My dear lovable students, have you calculated value of the unlevered firm? Yes, sir. Without tax, yes, sir. What was the value? 50 lakhs. How much lakh? 50 lakhs. What is the tax rate? 40%. That means from 100 rupees, 40 will go. Remaining 60 will be there. So 50 lakhs into 60% comes to that 30 lakh only you have achieved already here. Are you agree with me? So without tax, the value is 50 lakh. And if I am paying a tax rate of 40%, with the tax, the value of the firm will be 30 lakhs. Are you agree with me? Now I have completed the valuation of the unlevered firm. Now I am going to calculate the value of the levered firm is equal to value of the unlevered firm plus DT plus what? Tell me, my dear students, value of unlevered firm, if there is tax, will be how much lakh? 30 lakhs. Is debt is therefore levered firm? Another levered firm. Correct? What is the debt? 27 lakhs is the debt. 27 lakhs is the debt. What is the tax rate, my dear lovable student? 40%. That means how much lakhs plus 30 lakhs plus 27 lakhs into 40% comes to 10 lakh 80,000 will be the DT, right, sir? Abhi 30 lakhs plus 10 lakh 80,000 comes to 40 lakh 80,000 will be the value of the levered firm if there is tax. If there is, appreciating? That means, my dear lovable students, 40 lakh 80,000 is the value of the levered firm if there is tax, correct? But value of the unlevered firm is equal to how much lakh? 30 lakhs. That means 10 lakh 80,000 is the difference between value of the what in what? Levered firm and the unlevered firm, right, sir? If you see, sir, if there is tax, if you are holding 100% of the levered firm, you can have 6,69,600. But if you are holding 100% of the unlevered firm, you are having only 5,40,000. But 6,69,600 minus 5,40,000 comes to, you will be having 1,29,600 extra if you are unholding 100% of the what firm, levered firm. Can you proceed? Yes, sir, 1,29,600. Sir, why I am having extra 1,29,600? Because the levered firm have paid a tax of 2,30,400. Can you proceed? But the unlevered firm have paid a tax of 3,60,000. Correct? So 2,30,400 minus 3,60,000 comes to 1,29,600. This 1,29,600 extra is available with the levered firm. Comfortable? Why, sir, this guy has paid less tax? Why, sir, this guy has paid more tax? Because of interest. Because interest is a tax deductible item. Interest is a tax deductible item. Are you with me? If you see the interest, if you see the question, they are saying that, my dear lovable students, 12% is the KD. 12% is the, sir, the second company is having 1,29,600. Is this for 1 year, lifelong? Every year, this 1,29,600 will come. Every year, 1,29,600 will come. Right? That means the cash flow is a perpetual cash flow. What cash flow? The value of an asset today is equal to cash flow divided by R. The R is how much percent? 12%. So 1,29,600 divided by how much percent? 12% comes to 10 lakh. That is the difference between the first company and the second company, 10 lakh 80,000. That's what we are finding out as DT. That is the logic of debt into tax rate. Are you agree with me? Are you agree with me? So 40 lakh 80,000 is the value of the firm. Can I continue with the second part of the answer? So you tell me, sir, total value of unlevered firm, how much lakh? 30 lakh. Because if there is tax, the value of the unlevered firm reduces. Correct? What was the value of the firm if there is no tax? 50 lakh. And that they would have paid tax of 40%. So 50 lakhs and 40 lakh, 40% pochina, 30 lakhs. Abhi calculate pakura. Are you agree with me? You have to calculate as EBIT into N minus T, 1 minus T divided by KE. Can you proceed? Yes, sir. So KE of an unlevered firm is equal to KO of an unlevered firm is equal to how much percent? 18%. Are you settled? Now I am going to calculate the market value of the B limited. That is what firm? Levered firm. Ipa na yara value pora. Levered firm. If there is tax, value of levered firm will not be equal to the value of the unlevered firm. If there is tax, value of levered firm will be more than the value of the unlevered firm. Comfortable? Yes, sir. So value of levered firm is equal to value of the unlevered firm plus DT. Plus what? DT. What is the value of the unlevered firm? 30 lakhs. Plus what is the debt in the levered firm? 27 lakh. What is the tax rate? 40%. So 27 lakh into 40% comes to 10 lakh 80,000 plus how much lakh? 30 lakhs comes to 40 lakh 80,000 is the value of the levered firm if there is tax. Comfortable? Now, sir, the WACC, weighted average cost of capital of C limited. Who C? Unlevered firm. For them, the WACC is how much percent? 18%. Because KE is equal to, now I am going to calculate the KE and I am going to calculate the KO. Are you agree with me? Yes, sir. What is the EBIT of the levered firm? 9 lakhs. Less interest. Is there any debt in the capital structure? Yes, sir. Debt value of 27 lakhs. And the 27 lakhs interest, 12% comes to interest of 3,24,000. Are you able to appreciate, sir? From the EBIT 9 lakh, if you reduce 3,24,000, what is the earnings before tax? 5,76,000. Is the levered firm liable to pay more tax or less tax? Less tax because of charging interest. Am I right? So less tax at the rate of how much percent? So 5,76,000 into 40% comes to 2,30,400 is the tax. Comfortable? So you will be getting a PAT, profit after tax of 5,76,000 minus 2,30,400 comes to 3,45,600. Right? Already we calculated the what value of the firm. Always MM is saying that take the total value of the firm. In case yaar irkangana, tax irkangana, value of the levered firm will be higher than the value of the unlevered firm. Purida? That means already we calculated 40 lakh 80,000, which is much more than 30 lakhs. 30 lakhs was the value of the unlevered firm. Plus DT will be there for value of the levered firm. Sir, inside this 40 lakh 80, sir, debt value will be there and also equity value will be there. Can you reduce the market value of debt? Yes, sir. How much lakh? 27 lakh. That means, my dear lovable students, market value of equity will be 13 lakh 80,000. Can you proceed? That means, sir, to the equity shareholders, 3,45,600 is the earnings available to equity shareholders. In order to enjoy 3,45,600, they have to invest 13,80,000. So calculate 3,45,600 divided by 13,80,000 into 100 comes to 25.0% is the KE. Is the what? And can we calculate the KO, my dear lovable students? Yes, sir. What is the formula for KO? KO is equal to EBIT divided by value of the firm. What is EBIT? 9 lakhs. So 9 lakhs divided by what is the value of the firm? 40 lakh 80,000 into 100 comes to 22.05. Yeah, it's a KO. Sir, what is the EBIT? 9 lakhs divided by 40 lakh 80,000 into 100 comes to 22. But sir, is this, sir, weighted average N of capital, cost of capital? Is this NI approach? No. This is Modigliani-Miller. So KO is equal to, I have to use the MAC table. Correct? Can you calculate the WACC table? That's one. Yes, sir. That's one. That's what I read. Sir, can you use the WACC table? Yes, sir. Sir, we are having equity and what? Debt. What is the market value of equity? We just find out 13,80,000. What is the market value of debt? 27 lakh. So total value of the firm 40,80,000. Can you calculate the rate? Yes, sir. Can you calculate the K individual cost of capital? Already I find out KE as 25.04%. I will not take KD as 12% because tax is there. Correct? If tax is there, cost of capital should be after tax. Hello, sir. So 12 into 60% comes to 7.2%. Comfortable? If I calculate, I will get 13.23%. If you want, by using formula method, don't take the KO as EBIT divided by value of the firm. This will work out only if there is no tax. Correct? If there is tax, EBIT will not be available to the shareholder. To the all shareholders, agree with me. Actually, the KO means the total return. Correct? So don't use this formula because this formula will be applicable only if there is no comfortable. Yes, sir. So the WACC will be 13.23%. Sir, but the WACC of unlevered firm was how much percent? 18%. Correct? But the WACC of levered firm is how much percent? 13.23%. அப்ப ரெண்டு பேரோட WACC என்ன ஆகல? Match ஆகல. WACC is changing. KO is changing. That means MM should be theory of relevance. MM cannot be theory of. That's why from there arbitrage process is starting. What MM is saying that if there is tax, surely initially value of the levered firm will be more than the value of the unlevered firm. And slowly people will start from the levered firm to the unlevered firm called as primary arbitrage. Correct, sir? So we are having basically four theories are there. ENI approach, NOI approach, traditional approach, and the Modigliani-Miller approach. Right, sir? If you ask me to tabulate the five theories, my dear lovable students, sir, number 1, ENI, number 2, NOI, number 3, traditional, number 4, MM without tax, and MM with the tax. Are you with me? What NI 3 characters are there? KD, KE, and KO. Are you with me? What NI is saying that KD will be constant, KE will be constant, and KO will be variable. Hello, sir. What is the rule? What is the rule of NI? NI is saying that try to inject more, and more debt into the capital structure. Since KD is the cheaper source of finance, KD pulls down KO. When KO reduces, value of the firm increases. Are you with me? Yes, sir. Now coming to NOI, man, KD is constant, KE is variable, and KO is constant. The rule of NOI approach is saying that what the theorem or the rule is saying that if you inject debt into the capital structure, since KD is cheaper source of finance, KD reduces KO. But this but is a theory. But fear of equity shareholders increases and automatically KE increases and it exactly offset. Hence KO remain unchanged. Right, sir? Hence KO remain unchanged. Come on, traditional approach. What tradition is saying that KD is variable, KE is variable, hence KO is variable. Everyone is variable. Traditional approach is saying that when you inject more debt, when you inject debt into the capital structure, initially equity shareholders enjoy financial leverage. And initially KO reduces. Such point is called as optimum capital structure. Comfortable? With regard to MM, without tax, if there is no tax, value of unlevered firm is equal to value of the levered firm. Comfortable? Hence, KO of unlevered firm is equal to KO of levered firm. Here KO is equal to EBIT divided by value of the firm. Here, if there is tax, value of unlevered firm will not be equal to value of the levered firm. Hence, value of levered firm is equal to value of unlevered firm plus dt. Value of levered firm is equal to value of unlevered firm plus dt. Okay, sir? Yes, sir. And if tax is there, value of the unlevered firm is equal to EBIT into 1 minus t divided by k. K or k, what argument? EBIT into 1 minus t divided by k. Comfortable? With this, my dear lovable students, the concept revision of the first chapter, that is capital structure theories, comes to an end. And we have done with question number 1, which is question number 8. In the coming slot, we'll be solving again MM. You have to revise the theory, whatever we have done. The 2 questions we'll be solving, which we will be feeling it as a very cakewalk to proceed, my dear lovable students. We'll be discussing a super 2 question past examination RTP question. Have a full revision of theory, NI, NOI, traditional, MM without tax, and MM with tax. Are you all clear? So very happy afternoon to all. So we are doing capital structure theories revision. We understood that mainly there are 5 theories are there. NI approach, NOI approach, traditional approach, MM without tax, and MM with tax. So what is the basics of NI approach? NI approach is saying that try to inject more and more debt into the capital structure. If you are increasing the proportion of debt in the capital structure, automatically, since the debt is the cheaper source of finance, sir, KD pulls down KO. So when the KO reduces, value of the firm increases. For that, the basic assumption of the NI approach is that, my dear lovable students, you inject whatever percentage or proportion of debt, the expectation of the debt holders will not change. That means KD remain constant. And you inject whatever may be the proportion of debt into the capital structure, the expectation of the equity shareholders will not change. That means KE is also constant. So since both are constant, we can enjoy an advantage of the low cost debt. So KD pulls down KO, and when the KO reduces, automatically value of the firm increases. But NOI is having a criticism against NI saying that how this theory will work. Because if you inject more debt into the capital structure, yes, debt is a cheaper source of finance. There is no doubt about it. But if you start injecting debt into the capital structure, automatically an unlevered firm will become a levered firm. Then the equity shareholders in a levered firm is having a financial risk. So they will start debt fear, and automatically whatever benefit you have enjoyed by reduction in KO because of the KD, KE pulls up KO and KO remain constant. That means what NOI is saying that I don't want to analyze from the angle of the debt holders, KD will be constant, but KE will be variable, my dear lovable students. To what extent it is variable? To what extent KD pulls down KO? To that extent it will pull up KO. So to that extent it will be variable, and KO will be constant, my dear lovable students. KO, if KO is constant, value of the firm will not change. That's why NI is a theory of relevance and NOI is a theory of irrelevance. Are you with me? Coming to the next one, my dear lovable students, the traditional approach. What traditional approach is asking a question to the NOI approach that if you inject 1%, 5%, 10% into the capital structure, the equity shareholders will not get feared. Equity shareholders will enjoy, because initially up to a certain point of limit, my dear lovable students, equity shareholders will be able to enjoy the financial leverage because of favorable effect of financial leverage. So actually KD pulls down KO, and initially equity shareholders will not react, but they will start react. When they start react, not only the equity shareholders will react, but also the debt holders will be reacting. But the proportion or the percentage of reaction between the debt holders and the equity shareholders will be huge. That means equity shareholders will react so much multiple times as compared to the debt holders. So it will not exactly offset. So KO will never be constant. KO will be variable as per the traditional approach. Now, to extend the NOI approach, the MM asking. MM said that I will explain to you how it will be exactly offsetting. He said that, sir, all your propositions are without tax. So I am starting without tax. There are two companies are there. Number one, sir, MM without tax for levered firm and for unlevered firm. If there is no tax for a shareholder, for a debt holder, what is getting the returns from the levered firm will be equal to what he will get from the unlevered firm. So if there is no tax, according to MM, value of unlevered firm is equal to value of the levered firm. If that is the case, KO of unlevered firm will be equal to KO of the levered firm. Are you with me? If both KO are same, if both the earnings available from both the companies are the same, then why that those companies should have different value? So MM proved that if there is no tax, value of levered firm is equal to value of. That means it is irrelevant whether one company is having debt in their capital structure or does not have debt in their what structure? Capital structure, my dear lovable students. And MM come up with a beautiful formula of KO is equal to EBIT divided by value of the firm. KO is equal to EBIT divided by. This is the formula we will be using to find out the value of the unlevered firm. Are you with me? Yes, sir. But MM is having a difference of opinion. MM is saying that my theory is a theory of irrelevance. But if tax is there, tax benefit or tax savings will be there for a levered firm. Because of they paying interest for the debt, that interest will be debited to the P&L account. Because of that, a levered firm will be able to enjoy a tax benefit or tax shield. Are you with me? Then, my dear lovable students, if there is tax, value of unlevered firm will not be equal to value of the levered firm. So levered firm's value will be little higher than the value of the unlevered firm. That's why MM proposed a formula that value of levered firm is equal to value of unlevered firm plus DT, which is nothing but D stands for debt and T stands for tax rate. Are you with me? And how to find out the value of unlevered firm? My dear lovable students, value of unlevered firm is equal to, I can't take EBIT because EBIT into 1 minus T. 1 minus T will be the earnings available to the equity shareholders. Are you with me? So EBIT into 1 minus T divided by K. Here, better to write that. Value of unlevered firm is equal to EBIT divided by K. Correct? Whereas here value of unlevered firm, if tax is there, EBIT into 1 minus T divided by K. This is what yesterday we have done. And from this, my dear lovable students, we have solved one question, question number 1. And I'm moving into the next two questions, question number 2 and question number 3. And we'll finish it off this part called as capital structure theories. Can we? Sir, Blue Limited, an all-equity finance company, is considering the repurchase of 275 lakh equity shares and to replace it with 15% debenture of the same amount. My dear lovable students, this company is an all-equity company. So this company is a levered firm or unlevered firm. This company is an unlevered firm. Are you with me? For unlevered firm, 100% of the share capital will be equity, but they are going to inject debt into the what structure? Capital structure. To the extent of how much? 275 lakh. And to replace it with how much percent debenture? 15% debenture. That means KD is equal to 15%. Am I right, sir? Of the same amount. Current market value of the company is 1750 lakh. That means current market value of the company means market value of the firm or market value of the equity. Because the firm is a unlevered firm. Since the firm is an unlevered firm, current market value of the equity, with its cost of capital is how much percent? That means KO is equal to KE is equal to 20%. My dear lovable students, companies' earnings before interest and tax, EBIT, are expected to remain constant in what year? Future years. That means whether I inject debt or not into my what structure? Capital structure. Will the EBIT change? No, sir. Because EBIT is an operating result, not a financial result. Correct? Company also has a policy of distributing its entire earnings as what? Dividend. Okay, fine. Assuming the corporate tax rate as how much percent, you are required to calculate the impact on the following on account of change in the what structure? Capital structure. As per the MM approach, market value of the company, overall cost of capital, and cost of equity. Basically, what MM is saying that now the company is a all equity company. Now the company does not have debt at all, but please inject a debt of 275 lakhs into the what structure? Capital structure. Since tax is there, this company was an unlevered firm before. Correct? So the value will be X. But since tax is there, if you inject debt into the what structure? Capital structure. Initially, my dear lovable students, value of the levered firm will be more than the value of the unlevered firm. So I am going to analyze this question, man. Currently, this question is this company is a what type of company? Unlevered firm. What is the value of the firm? 1,750 lakhs. Are you with me? Sir, this 1,750 lakhs consists of how much equity and how much debt? Zero debt and 100% equity. Am I right, sir? Why, sir, 100% equity? Because this company is a all equity company. That means for all equity company, if there is tax is there, they said that value of equity is equal to value of firm as 1750 lakhs and KE is equal to KO is equal to 20%. That means, my dear students, sir, we all know that, sir, KE is equal to earnings available to the what shareholder? Equity shareholders divided by value of equity. That means KE is how much percent? 20% is equal to earnings available to the equity shareholders divided by 1750 lakhs. Am I right? So earnings available to the what shareholder is equal to 1750 into 20% comes to, sir, 350 lakhs is the earnings available to the equity shareholders. Can I proceed? Is this profit before tax or profit after tax? Profit after tax. There is tax in the company. Correct? So 350 lakhs is the PAT. Are you related with me? So I want the profit before tax. So 350 lakhs divided by 1 minus 0.3 comes to 500 lakhs is the earnings before interest and tax. That means this is what they have done here. Just be with me. Market value of equity is equal to earnings available to equity shareholders divided by KE. That means 1750 lakh is equal to, sir, earnings available to equity shareholders divided by KE. That means earnings available to equity shareholders is equal to 1750 into 20% comes to 300 and this is the PAT, profit after tax. Because in this question there is tax. I want to convert into profit before tax, which is nothing but EBIT, because this company is a all equity company. There won't be any interest. So 350 lakhs divided by 1 minus 0.3 comes to 500 lakhs is the earnings before interest and tax. So let me ask you a question. If the company from the status of all equity company, if the company has become a levered firm, will the EBIT change or will not change? That's why whether EBIT under all equity option and EBIT under the equity and debt option are 500 lakh. But if you inject debt of 275 lakh at an interest rate of 15%, so 275 into 15, you will pay 41.25 lakhs as the interest. But when you was a cash equity company, all equity company, my dear lovable students, this was not there. Are you really with me? So the earnings before tax of all equity company is 500 lakhs, whereas earnings before tax of the levered firm will be EBIT minus interest. On that earnings before tax, pay tax at the rate of 30%, which comes to 150 and 137.63. So the income available to the equity shareholders, earlier equity shareholders were able to enjoy 350 only total. But now 321.12 plus 41.25 comes to 362.37 is what the total owners of the company will be able to enjoy. Because once you inject debt into the what structure? Capital structure. Sir, interest is a tax deductible expenses. Because of that, your tax outflow reduces. Am I right? So I am going to calculate the market value of the company. My question to you, sir, when the firm was a unlevered firm, what was the value? 1750 lakhs. Are you with me? Once you inject debt into the what structure? Capital structure. The unlevered firm will become levered firm. Sir, if there is tax, is value of levered firm is equal to value of unlevered firm? No. The value of levered firm will be more than the value of the unlevered firm. So the market value of the what firm? Levered firm is equal to value of unlevered firm plus tax advantage, which is nothing but DD. So what is the value of unlevered firm? 1750 lakhs. How much tax debt you have injected now? 275 lakhs. Right, sir? Into 30% comes to 82.5. So 82.5 lakhs will be the additional value because of changing from what company to what company? Unlevered firm to levered firm. This is nothing, sir. This first company, when you are an unlevered firm, you paid a tax of 150 lakhs, but now you are paying only a tax of 137.63. So 150 minus 137.63 comes to, sir, 12.37 lakhs is the extra money available with the levered firm because of injecting debt into the capital structure. And the debt percentage is how much percent? 15%. This divided by 15, that is 12.37 divided by 15 comes to 82.50 lakhs. That's what the extra 82.50 lakhs. Are you able to tally? So what MM is saying that if you convert an unlevered firm into levered firm, if there is tax, always the value of the levered firm will be much more higher than the value of the unlevered firm. Can I proceed? That means, my dear lovely students, now the value has become 1832.5 and earlier the value is 1750. So there is an addition of 82.5. We already analyzed why there is a reason. So this is what the first requirement of the question. What is the impact on the market value of the firm? If there is tax, the market value of the firm increases. So the impact is that market value of the company has been increased by 82.5 lakhs due to replacement of what with what? Fine, sir. So I'm going to calculate the overall cost of capital, sir. Overall cost of capital, which is nothing but KO. First of all, I am going to calculate the market value of equity. After you change it from unlevered firm to levered firm, have the value increases? Have the value increases? Yes, sir. Yes, sir. Sir, from how much lakhs value? 1750 lakhs value. It has been increased to 1832.50 lakhs. Correct? According to MM, this comprises of value of debt and value of equity. You know the value of debt, how much you have injected. What is the value of debt? 275. From the total value of the firm, if you reduce debt of 275 lakhs, you will get 1557.50 lakhs is the market value of equity. Are you with me? If you invest this much amount in the company, you can enjoy the profit after tax of 321.12 lakhs. Am I right? That means you can calculate the KE as earnings available to equity shareholders divided by market value of equity into 100. Can I proceed? Tell me, my dear students, what is the earnings available to equity shareholder after you become a levered firm? 321.12 divided by what is the market value of equity? 1557.50. Getting it? That means, my dear lovable students, the KE is 20.62%. The analysis, when the company was a unlevered firm, correct, the value was just 1750 lakhs. And the KE of the company is 20%. Hence, the KO of an unlevered firm is also 20%. Can you proceed? But now, you converted the unlevered firm into levered firm. So, if you convert the unlevered firm into levered firm, you are injecting debt into the capital structure. Automatically, the equity shareholders of the levered firm will start getting fear. Yes, sir. That's why from KO of 20%, they have shoot up to 20.62%. Comfortable? Is tax there or not there? Tax is there. Sir, if tax is there, I will not take KD as a coupon rate. I will not take KD as a generally KD in capital structure theories. KD is equal to coupon rate. Correct? But only in one situation, that is MM approach with the tax. Since you are having tax benefit or interest, my dear students, KD should be I into 1 minus. KD should be, what is the I man? 15% is I. 1 minus 0.3 comes to 0.7. So 15 into 0.7 comes to 10.5 is the KD after tax. It's not KD. KD Now I am going to calculate the WACC. First, before I calculate the WACC, sir, when the company was a unlevered firm, what was the KE of the company? 20%. That means what was the KO of the company? 20%. Sir, what was the value of the firm? 1750 lakhs, right, sir? But once the company has become levered firm, you tell me KE increased from 20%, it has been increased to 20 point. The reason or the logic is you have converted an unlevered firm into a levered firm. That means the equity shareholder of the levered firm start getting fear. So automatically the expectation increases. That's why KE increases. Comfortable? My dear students, sir, now the value of the firm has been increased from 1750 or decreased. Increases. That's why value of the firm become 1832.5. Am I right with the figure? Sir, the value of the firm increases, KO should reduces. Agree with me? Because if the KO reduces, only value of the firm increases. Can I proceed? My dear students, that means earlier KO was 20%. Now the new KO should be less than. With this mindset, I'm going to work out the KO. I understand what I'm talking to you. So what is the equity, man? Market value of equity comes to 1557.5. Correct? Market value of debt is 275. Comfortable? That means the total comes to 1832.5 is the market value of the firm. Which firm? Levered firm. Which is more than the value of the unlevered firm. Now, have I calculated KE? Yes, sir. Which is 20.62%, which is much higher than KE of the unlevered firm. And KD, sir, I will not take the coupon rate as KD. Since tax is there, I will be taking KD is equal to I into 1 minus T. Agree with me? That means 85% of my equity represent the total capital employed. 15% of the equity, sir, capital structure represent the debt. So calculate 20.62 into 85% comes to 17.53%. Can you proceed, sir? And 15 into 10.5% comes to 1.58. And the KO of the levered firm, sir, dropped from 20% to 19.11%. That means there is a fall in KO of 0.89%. That is why there is a increase in the value of the firm. Can you proceed? That's it. So this is what the impact in the cost of equity. Sir, the impact in the cost of equity is raised by how much percent? 0.62%. Why the equity has to be increased? Because you have injected it into the structure and you have converted the unlevered firm into a automatically equity shareholders of the levered firm will start fearing. That's why the expectation has been raised from 20 to 20.62 due to the presence of what is financial risk. That is introduction of debt into the structure. Sir, the impact of the cost is cost of capital. Sir, that's it. We have analyzed the impact on the value of the firm. You look at the coming to the answer, man. Sir, when you analyze this market value of the company increased. Because of conversion from the unlevered firm to the levered firm, sir, always if there is tax, value of the levered firm will be higher than the value of the unlevered firm. Comfortable? Overall cost of capital reduces because if the value of firm increases, sir, overall cost of capital should reduces. And cost of equity increases from 20%, KE has become 20.62%. Are you agree with me? Sir, the same question can be worked out by using formula method. Are you agree with me? What Modigliani-Miller is saying that, my dear students, cost of capital, what is cost of capital? KO. And cost of equity, what is cost of equity? KE can also be calculated with the help of following formula. Though there will be no change in the answer, final answer. So till now, I have applied the table approach. Now I am going to apply the formula approach. MM said that cost of capital, that is KO, is equal to KE of an unlevered firm. Sir, if there is no tax, value of levered firm is equal to value of the unlevered firm. KO of an unlevered firm is equal to KO of the levered firm. That's why, sir, MM is also saying, if there is no tax, my dear students, E of an unlevered firm should be the KO of the levered firm. Am I right? But if there is tax, my dear students, because of tax shield, because of the tax benefit available to the debtor, sir, the value of the levered firm, sir, will increase. That means KO of the levered firm decreases. Are you with me? That's what saying that into, sir, 1 minus TL. 1 minus what? L stands for leverage. L stands for what? Leverage means debt divided by debt plus equity. Debt divided by. So the same thing we can calculate by this formula very easily. We already calculated the KO by using WACC table. Just now we saw and we got the answer as 19.11%. Can you proceed now? My dear students, what is the KO or KE of an unlevered firm? 20%. Generally, if there is no tax, my answer over. Because value of a levered firm is equal to value of the and the KO of an unlevered firm is equal to KO of the. But here there is tax. So I am having tax benefit. I am having tax shield. Correct? How much tax benefit or tax shield I will be having in my capital structure? How much? Debt is there. That much only I can enjoy the capital structure. Right? So my dear students, 275 is the debt. Hello, sir. So what is the total value of the firm? 1832.50. Are you with me? So out of 1832.50, 275 divided by 1832.50 means 15% is the proportion of debt in our structure, capital structure. So for that 15%, I will get 30% tax benefit. Are you with me? So into 0.3 means 4.5% will be the tax saving or tax benefit. Are you with me? So into 20% comes to 19.0 into, sir, 0.0 minus 1, correct? Yes, sir. So 275 divided by 1832.5, you will get the proportion as 15%. For this 15%, you will get the what benefit? Tax benefit minus 1 into, sir, 20% comes to 19.10% is the KO as per formula method. Are you with me? The same 19.10 we have derived by using the WACC also 19.11. Only, sir, round of difference are there. Are you with me? So tell me, as per MM approach, we can calculate the KO of a levered firm is equal to KO of an unlevered firm into 1 minus TL. 1 minus T stands for tax rate and L stands for leverage, which is nothing but debt divided by debt plus equity. Comfortable? Now I am going to calculate the KE of a what firm? Levered firm. KE of a levered firm means you are a shareholder in a levered firm, correct? If you are a shareholder in a levered firm means do you have risk? Yes, sir. You are having more risk than a shareholder to be in an unlevered firm, correct? If I am a shareholder in a unlevered firm, I will be expecting only KE of an unlevered firm. This is my RF, a risk-free return. Because if I was a shareholder in a what firm? Unlevered firm, there is no risk there, there is no debt there, so I will be expecting a RF risk-free return. But if I am shareholder in a levered firm, there is debt in the what structure? Capital structure. So I want a risk premium. What premium? Risk premium is nothing but, my dear students, KE of an unlevered firm minus KD. This is nothing but, sir, RM minus RF. What minus what? RM minus RF. What minus what? Into debt divided by equity is the proportion. Am I right? Since there is debt in tax in the concern, so into what minus T? 1 minus T. Only for debt tax benefit will be there. Only for debt, sir, tax savings will be there. That's why they have put in numerator debt into 1 minus T. You can put debt divided by equity into 1 minus T also, still you will get the same answer. Am I right, sir? So, sir, apply it. What is the RF, sir? If you are an equity shareholder in an unlevered firm, what is your expectation? 20%. Sir, will you expect same 20 or more than that? More than that. For the amount of the, sir, debt. How much is the amount of debt in the by 7.5. Am I right, sir? Yes, sir. Into, my dear lovable students, what is the tax rate? 0.7 because 1 minus t. Yeah. Yes, sir. Yes, sir. Into what is the risk premium you are taking? 5%. So into 5 comes to 0.62 is the risk premium for this level of debt. That means 20 plus 0.62 comes to 20.62% is the KE of the levered firm. Correct? We already calculated KE of the levered firm by using the formula. Then also we got KE as 20.62%. Now under the direct formula method also we are getting 20.62%. Are you able to appreciate? Are you able to appreciate? That's it. So under Modigliani-Miller approach, we have studied that. We can add that. Sir, under Modigliani-Miller, we can classify things into two categories. Number one, value of unlevered firm, value of unlevered firm, and value of levered firm. Sir, value of unlevered firm, tell me what is the value? How you will find out the value? Sir, you have to classify into two categories. Tax there, tax not there. If tax not there, na, EBIT divided by KE, KE or KO. Sir, if tax is there, na, sir, EBIT into 1 minus T divided by, can I proceed, sir? Coming to the value of the what firm and levered firm. Again, you are having what man? Sir, no tax, there is tax. If there is no tax, value of the levered firm is equal to value of the unlevered firm. Can you proceed? My dear lovable students, if there is tax, then the value of the levered firm will not be equal to value of the unlevered firm. Value of the levered firm is equal to value of the unlevered firm plus GD. Right? And the KO of the levered firm is equal to KE of the unlevered firm into 1 minus TL. Are you with me? And KE of the levered firm is equal to KE of the unlevered firm plus KE of the unlevered firm minus KD into debt divided by equity into 1 minus T. If the same formula you are applying for without tax, please ignore 1 minus T. Are you with me? If no tax, 1 minus T should be ignored. 1 minus T should be ignored. Comfortable, sir? That's it. With regard to question number 2, we are moving to the last question from this area, which is question number 3. Zordan Limited as net operating income of how much lakh? 5 lakh. That means EBIT of 5 lakh. And total capitalization of how much lakh? 50 lakhs. That means total capital employed is 50 lakh. During the current year, company is contemplating to introduce debt, financing in the what structure, capital structure, and various options for the same. Following information is available at different level of debt value. You tell me, my dear lovable students, sir, if Z Limited's net operating income is 5 lakh and their capital employed is 50 lakh, my dear lovable students, company is contemplating to introduce debt into the capital structure means, if you capital structure, that means now the company is a all equity company or unlevered firm. Correct? Yes, sir. Following information, if the debt is 0%, sir, KE will be 10% only because there will not be buy-up to the equity shareholders. But if you inject debt of 5 lakh, the KD will be equal to 6% and KE will slightly increase from 10 to 10.5% because you are injecting debt into the what structure. Sir, if you are injecting 10 lakh rupees debt into the what structure, capital structure, KD will be same, whereas KE will slightly increase from 10.5 to, if you are again injecting debt of 15 lakh, sir, KD will start reacting from 6, it will move to 6.2 and KE will from 11 to 11.30. Comfortable? Sir, if you are making the debt value as 20 lakh, then KD will be equal to 7% and the KE will be equal to 12.4%. Comfortable? Sir, if the value of debt is 25 lakhs, my dear lovable students, KD will be equal to 7.5% and KE will shoot up to 13.5%. But if you are making the value of debt to 30 lakh, the KD will be equal to 8% and the KE will be equal to 16%. Can I proceed, sir? Assume no tax. Oh my God, there is no tax. And at the firm, always maintain books at what value? Book value. There is nothing to do with the market value. You are required to calculate amount of debt to be employed by firm as per what approach? What is the rule of traditional approach? Traditional approach is saying that at every capital mix, you'll be having different KO. You have to choose a capital mix having the lowest KO that will be taken as the optimum capital structure. Only under the traditional approach, we are having the concept of optimum capital structure. Whether under NI approach or NOI approach or the MM approach, we don't have a concept of what at all. And equity capitalization rate, that is KE, if MM approach is followed. Can you calculate the amount of debt to be employed by firm as per traditional approach? That means under every option, we are supposed to calculate the KO and we have to find out an option which is the least KO. First one, what is the total capital employed? 50 lakhs. You tell me in option number 1, there is no what at all, debt at all. That means the, sir, debt divided by total capital employed is 0%. Not even 1% debt is there in the what structure. If there is no debt in the capital structure, entire value represent equity only. That means then weight of equity will be 100%. Weight of equity will be, but out of the capital, total capital employed of how much lakh? 50 lakhs. If I am injecting debt of 5 lakhs, 5 lakhs divided by 50 lakhs means 10%. Correct? From 50 lakhs, if I reduce how much lakh? 45 lakhs will be the equity value and 90% will be the weight of the equity. That means in second option, out of my capital structure, 10% is debt and 90% is equity. Can I proceed? The same way we have to repeat for the remaining cases. If the capital employed is how much lakh? 50 lakhs and the debt is 10 lakh. How much percent debt? 20% debt. If 20% debt, 80% equity. Can I proceed? Out of 50 lakhs, if you are injecting debt of 15 lakhs divided by 50 lakhs comes to 30% of debt, then 70% of equity. Can I proceed? My dear lovable students, out of 50 lakhs, if you are injecting 20 lakhs as debt, 40% of debt and remaining 60% of equity. Can I proceed? Out of 50 lakhs, if you are injecting 25 lakhs of debt, 50% of and 50% of. Out of 50 lakhs, my dear lovable students, if 30 lakhs, if you are injecting as debt, 60% is debt and 40% is equity. Are you done with the proportion? Now I am going to calculate the back under the traditional approach. What is the theory? What is the theory of traditional? Under every capital mix, we have to find out the KO. And we have to choose a capital mix which is the lowest KO. Able to follow? Come on, man. Sir, in the first one, situation number 1. Sir, what is the KE? How much percent proportion? 100%. That is 10% was the individual cost of capital. Yeah, that's why I have written 10%. Look at the question. Sir, second situation, 10.5%. Third situation, question, 11%. Then 11.3%, 12.4%, 13.5%, 16%. That means if you keep on inject debt into the what structure? Capital structure. The fear of equity shareholders increases and the KE increases. Can I proceed? Okay, sir, what is the weight of the equity, sir? First one, 100%. It was what only? All equity only. Situation number 1. But in situation number 2, we injected 10% debt. So 90% become the weight of the, then 80, then 70, then 60, then 50, then 40. Can I proceed? Sir, come on. What is the KD, individual cost of capital? In the first situation, KD is nil because in the first situation, in the capital structure, then you injected 6%, 6.2%, 7%, 7.5, and 8%. As per traditional approach, KD is not constant. If you inject more and more debt into the what structure, even KD will also increase. Are you with me? KD increases, hence KO increases. That is why my theory is the theory of relevance. If two companies are alike in all aspects, except what structure? Yes, what will change? Come on, man. What is the value of debt? First one 0% because NNA illa, debt illa. Then slowly you start reducing from the equity. 10%, 20%, 30%, 40%, 50%, 60%. Can you calculate the individual cost of capital? That is KE into weight of the KE. What was the KE? 10%. What was the rate? 100%. 10 into 100%, 100%. So here KD, there is no KD at all. Correct? So the cost of capital is how much percent? 10%. 10% is the KO. Can you proceed? In second situation, you have to participate and tell me what was the KE individual cost? 10.5. What is the weight of the KE? How much percent? 90%. So 10.5 into 90% comes to 9.5%. 9.5% is the weighted KE. Weighted? What was the KD? 6%. What is the proportion? 10%. 6 into 10%? 0.06%. Plus 0.06 comes to, tell me, 10.05%. That's why they are out of 10.1%. Hello, sir. My dear lovable students, that means if you inject how much percent debt into the capital structure? 10% debt into the what structure? Capital structure. Sir, KO increases. KO? If KO increases, value of the firm decreases. That means this is not the right option. This is not a. Now again, I'm injecting debt into the what structure? Capital structure. You have to quickly tell me what is KE? 11%. 11 into proportion? 80%. So 11 into 80% comes to 8.8%. What is KD? 6%. What is the proportion? 20%. 6 into 20% comes to 1.2%. So 8.8 plus 1.2 comes to 10%. That means this is equal to this. This is indifference point. If you are all equity company or if you are a levered firm with 20% debt, your value will be the same. Because KO did not change that. Are you able to appreciate that? Next one, KE become 11.3. But the proportion fall down to, so 11.3 into 70 means 7.91%. Can I proceed? And my dear lovable students, KD 6.2 into 30% comes to 1.86%. Right now. So points are 1.86%. 7.91 comes to 9. Okay, this is better. Because earlier the KO was 10%. Now, because of injecting how much percent debt? 30% debt. So KO reduces value of the firm. So according to me, as of now, it's better to inject how much percent debt in the capital structure? 30% debt in the capital structure. So this is the best option. Actually, at this option, the value of firm will be highest. That is why this is called as optimum. Now, okay, debt inject 12.4 into 0.6% comes to 7.4%. 7% into 40% comes to 2.8%. So 7.4 plus 2.8 comes to 10.2. Reverse it. என்னன்னா முன்னாடி கம்மியான கேவோ என்ன ஆரம்பிச்சு திருப்பி என்ன ஆகும்னா இன்க்ரீஸ் ஆகும். சோ இதுக்கு அப்புறம் டெட் இன்ஜெக்ட் பண்றது ஒரு ரைட் ஆப்ஷன் கிடையாது. Correct? So the amount of debt to be employed is 15 lakh because WACC is minimum at this date of 9.8%. So this is the best WACC. Okay? Are you ready with me? That's it. That's what the traditional approach. So by this question, they are testing, do you know the theory of the traditional approach? What traditional approach is saying that if you inject debt into the what structure, KD changes. அப்புறம் KE also change. இவங்க ரெண்டு பேரும் என்ன ஆகுறதுனால சேஞ்ச் ஆகுறதுனால KO கட்டாயமா சேஞ்ச் ஆகுது. பட் இவங்க சேஞ்ச் ஆகுற விதம் வேற மாதிரி இருக்கும். உடனே கேடி சேஞ்ச் ஆக மாட்டாங்க. உடனே கேடி சேஞ்ச் ஆக மாட்டாங்க. லைட்டா தான் கேடி சேஞ்ச் ஆவாங்க. லைட்டா தான் கேடி சேஞ்ச் ஆக ஆரம்பிப்பாங்க. பட் ஒன்ஸ் சேஞ்ச் ஆயிட்டாங்கன்னா அரபுல சேஞ்ச் ஆயிடுவா. யாரு? KE. ஹலோ சார். இல்லாம இன்னும் ஐ அப்ரோச் சொன்ன மாதிரி எக்ஸாக்ட்லி என்ன செட் ஆகாது. I'm continuing with the second part of the question. Equity capitalization rate, if what is followed, MM approach is followed. So as per MM approach, that is Modigliani, cost of capital, KO remain constant because tax there, no tax. If there is no tax, value of the levered firm is equal to value of the, and cost of equity increases linearly with the debt. MM is saying that yes, pa, it is exactly offset. It is exactly. நீ நினைக்கிற மாதிரி எக்ஸ்ட்ரா எல்லாம் இன்க்ரீஸ் ஆகாது. அது with me. Sir, do you know? Sir, can you say what is the value of the firm formula? If there is no tax, as per MM, value of the firm is equal to EBIT divided by KO. Is the EBIT of the firm net operating income given in the question? Yes, sir. How much lakh? 5 lakh. Is the value of the firm total capital given in the question? How much lakh? About 50 lakhs is equal to 5 lakhs divided by KO. About KO is equal to 5 lakhs divided by 50 lakhs. Comes to 10%. 10% is the existing KO. Correct? That means as per MM, if there is no tax, who will not change? Value of the firm will not change. Rather, who will not change? KO will not change. Value of the firm will not change. That's why KO column is same as per MM. As per traditional approach, I wrote KE, I wrote KD, I find out. But as per MM approach, if there is no tax, value of the levered firm is equal to value of the concept. Okay, so super. So in situation number 1, what was the debt? 0 debt. What is the equity? 50 lakhs. What is the debt to bar equity? There is no proportion of debt at all. What was the KO of the firm? 10%. What is the KD? 0. So KO minus KD, 10%. That means KD is equal to 10%. Situation number 2, we make you understand, man. Sir, what is the debt? How much debt you inject? 5 lakhs. Then equity will become 45 lakhs. So now the debt divided by equity, sir, 5 lakhs divided by 45 lakhs into 100 comes to 11%. Is the proportion? Yes, sir. Yes, sir. Sir, what is the KO? 10%. What is the KD? 6%. What is KO minus KD? KO 11%. 10. Minus 6 comes to 4%. Am I right, sir? So can I calculate the KE? KE of a levered firm is equal to RF plus beta into R minus R, which is nothing but KO plus. What is the KO? 10%. Plus what is the KO minus KD? It will change. Keep on changing. Yeah. In the case 4%. In what is the debt to by equity proportion? 11%. Am I right? That means 4 into 11% comes to 0.44 plus 10 comes to 10.44 is the KE. Appreciating. That means what MM is saying that if there is no tax, value of the levered firm will be equal to value of the, and KO of unlevered firm is equal to KO of the, and KE of a levered firm is equal to KO of a unlevered firm plus KO of unlevered firm minus KD of the levered firm, or rather KD into what by what? Debt by equity. Tax there, tax not there. If tax is there, I will put 1 minus T. If tax is not there, I will avoid this 1 minus T in the calculation. Clear concept. So come on, man. So I'm going to inject debt of how much lakh? 10 lakhs. Then what will be the equity position? 40 lakhs. 10 lakhs divided by 40 lakhs means 25%. Is that a component? Come on. What is the KO? Will change? Will not change? Will not change. What is the KD? 6%. Even that is also will not change. 10 minus 6, 4%. Can you calculate the KE? Tell me what is the formula for KE? KO plus, what is KO? 10 plus, KE minus KD, 4 into proportion, 25%. 4 over 25, 1%. Yes, sir. 4 over 25%, 1%. Correct? Then, plus, then comes to, that's a game over. Like that, you have to put, sir, if I inject 15 lakhs as data, automatically equity will become, sir, 15 divided by 35, 43%. Anyway, this will not change. But KD is increasing, correct? Yes, sir, comes to 6.2%. Now, KO minus KD will also increase. Because KO will not change at any cost man as per MM. But KD may increase. What MM is saying that according to me, KD increase, matter. Because NA said that KD is constant. Correct? Sir, I said that KD is constant. Are you with me? But traditional approach said that KD is variable. MM saying that it is irrelevant for me. For your capital structure, KD increases, okay, I'm ready to accept the KD is increasing. If KD is not increasing, no problem. Because automatically my formula will take care. My dear students, are you with me? Yes, sir. My formula is RF plus beta into R minus. So I'm least important about whether KD is what or not, increasing or not. Sir, sorry, sir, tell me. What is KO? 10 minus 6.2 comes to 3.8 into proportion 43%, which is 1.634 plus 10% comes to 11.6%. This is the KE of the, it will exactly offset, my dear students. Can you finish it off? Yes, sir. Sir, if you inject debt of 20 lakh, equity will become, proportion will become, proportion 67%. Correct? 20 lakhs divided by 30 lakhs, 67%. 30 lakhs divided by 67%. Yes, sir. KO remain constant, 10%. Sir, KD 7%. Can you calculate, sir? So 10 minus 7, 3%. Come on, sir. 3 into 67% comes to 2.01 now. 2.01 plus 10% comes to 12.01. Is the KE of the what form? Last two situation 25 now. 50. Yes, sir. That means 100% it shows the debt because 25. Correct? Yes, sir. Sir, in the 10, sir, KD becomes 7.5. 10 minus 7.5, 2.5. 2.5 full up, 2.5. 10 plus 2.5 is 12.5. Is the KE. And here 30 lakhs and 20 lakhs are become 150% over because sir, equity rate return. Sir, KO remain constant. That means KD is how much percent? 10 in equals 2%. 2 out of 150 comes to 3. 10 plus 3 comes to 13%. That's it. This is how you are supposed to work as per the MM approach. Good question, good application. Are you with me? Are you able to conceptually understand what is happening, my dear students? That's it with regard to the 5 theories of capital structure theories. NI, NOI, traditional approach, MM without tax, and MM with tax. What NI is saying that try to inject more and more debt into the capital structure. KD pulls down KO. Once KO reduces value for that's a game over. Whereas NOI is saying that sir, KO, KD reduces KO, and KE pulls up KO. KO remain constant. That's it. Game over. What traditional approach is saying that, sir, it will not be exactly offset. Initially, there will be financial leverage, but later it will start increasing. But KE will increase cheaper than KO, so it will not exactly offset. Hence, KO will not be constant. KO will be variable. Once the KO changes, value of the firm changes. The MM is saying that if there is no tax, value of the levered firm is equal to value of the unlevered firm, and if there is tax, value of the levered firm will be more than the value of the unlevered firm. Now, people start a question to MM that if there is tax, if value of the levered firm is higher than the value of the unlevered firm, then your theory is a theory of relevance. Then why are you saying my theory is a theory of? MM said that I will answer you through a process called as arbitrage. What process? Through the arbitrage, he explained what is primary arbitrage and what is secondary arbitrage. The coming slot, we are going to talk about what is primary arbitrage and what is secondary arbitrage is a target. Are you all really with me? Have a revision of the provisions, what we discussed, and also the 3 question you come back. We will complete the next beautiful concept called as arbitrage process.